If you run your own business, chances are your accountant has handed you two mysterious documents, a profit and loss and a balance sheet. You look at them, deep down you're thinking, what am I even looking at? And why are these two of them? Well, if that's the case, this video is for you. By the end of the video, you'll not only understand what each statement means, you'll actually know how the profit and loss and balance sheet work together to give you the full picture of your business health. We're going to unpack them in plain English with real-life examples and practical tips you can actually use. So next time your accountant emails you these reports, you won't just nod politely, you will actually know what they are telling you. Hi, I'm Molly, the founder of Above Advisory and a certified accountant with over 15 years experience helping business owners not just file their tax returns, but actually understand them. If you are into clear tax and business tips, make sure to hit that subscribe button so you never miss one. The profit and loss isn't just some dusty reports for your tax office. It's actually your business health check. Imagine driving your car with no dashboard. You might still get somewhere, but you have no clue if your engine's about to blow or your fuel tank's bone dry. In short, your profit and loss is your dashboard for your business. It tells you if you're making money, losing money, or just working hard to keep the lights on. In plain English, your profit and loss statement shows you money in, which is your sales and other income. Money out, which is your expenses. Lastly, what's left over, which we will show you at the end of the statement, your profit and loss. Before we dive into the statement in detail, let me take you through the simple statement as an example for a broad context. Throughout the financial year, let's say you made $100,000 in sales, and your cost of goods sold, which is normally called as COGS, is $40,000, which will lead to gross profit of $60,000. So you might be wondering, wait, Molly, what's gross profit? Gross profit is the money left after you cover the direct cost of making or selling your product or service. It's very important to understand because it shows how efficiently you turn sales into profit before paying your overhead like rent or wages. Your ideal gross profit margin typically depends on your industry. A cafe might aim for 65 to 70%, retail might be closer to 30 to 40%, and consulting can be between 80 to 90%. And to work things through net profit, you'll need to deduct your operating expenses, which in this case, let's say is $50,000. So your net profit will be $10,000. And that $10,000 is before tax, which means yes, ATU will still want its share. You'll have to pay company tax or business tax on your net profit. So the first section of your profit and loss shows all your income sources. Say you own a cafe. Most likely, you have revenue come from coffee sales, pastry sales, catering, which made up your total sales of $100,000. This isn't just a bunch of numbers to skim over. Breaking down each type of your revenue tells you exactly where your income is coming from and whether your business is balanced or heavily leaning on one thing. So you should ask yourself these questions when you go through the revenue section. Which product or service is pulling the most money? Is my income spread across different streams, or is it just from just one? Are there any revenue streams growing or quietly shrinking in the background? By keeping an eye on your revenue breakdown, you can double down on your best sellers and spot seasonal patterns like iced coffees flying off the shelves in summer or soups in winter. Your revenue section is basically a map of where your business shines and a warning like if you are relying too much on one hero product. So now, let's move on to over the cost of goods sold. COGS are the costs directly tied to what you sell. This is basically the money you spend directly to make or deliver what you sell, like I explained before. For a cafe, that's coffee, beans, milk, sugar, takeaway cups. For a clothing store, it could be things like cost of buying or producing the clothes. For a web designer, it might be software license or stock images for client projects. When you look at your cost of goods sold, ask yourself these questions. Are these costs in line with my sales? Have they gone up recently? If yes, why? Am I getting a good deal from my suppliers? Why does evaluating these costs actually matter? If your cost of goods sales is eating up too much of your revenue, your profit will take a hit. Let's say you make $100,000 in sales. but your cost of goods sold is $70,000. That leaves you only $30,000 before you even pay rent, wages, or marketing. That's a big warning sign. For example, if your cost of goods sold takes up 70% of your total sales, which means you only have with 30% left to cover everything else. It's like selling lemonade for $10 but spending $8 on lemons. You're basically running a charity for thirsty people. That's why keeping cost of goods sold under control gives you much more breathing room in your gross profit. Sometimes that means negotiating better prices with suppliers, buying in bulk, or tweaking your menu or product range to focus on higher margin items. If you're unsure of what your cost of goods sold percentage should be, ATU actually has a guide by industry, and I'll link that link in the description below. After cost of goods sold, you get gross profit. It tells you how much money is left before you pay rent, staff, marketing, and so on. You can also calculate your gross profit margin using this formula, which is gross profit divided by revenue times 100, and it will give you a gross profit margin percentage. Try to calculate your business gross margin and see how it is. I have provided industry benchmark here for you to refer to. If your margin's way below the industry average, your prices might be either too low or your cost might be too high. Now, let's move on to the last main part of the profit and loss statement, which is operating expenses. These are the costs of running your business day to day that aren't directly tied to making or selling your product. Think of them as the cost to keep the doors open and the lights on. Some common examples can include rent for your shop or office, staff wages, and superannuation, marketing and advertising costs, and so on. You should also keep an eye on these, especially sneaky recurring subscriptions. Like Netflix in your cafe might be keeping your customers happy, but is it really paying your bills? Okay, now it's time to proceed to the most exciting or nervous part. Is your business operating at a net loss or net profit? You can get the amount through this formula, which is gross profit minus total operating expenses. Net profit or loss is the amount your business truly earns before tax. It's very important in this part to understand that if your net profit for your business is $10,000, doesn't mean $10,000 goes straight to your pocket. Remember, you got tax to pay, maybe loan repayments, maybe reinvestment back in the business. Think of it as your business take-home pay before the government takes its tax and pay cut. Before we wrap up, a lot of people get confused when they see the profit and loss alongside the balance sheet. So let me clear that up. Profit and loss statement shows your income and expenses over a period of time, like a scoreboard for a match. It resets every financial year. Balance sheet shows your assets, liabilities, and equity at a single point in time, like a photo of your business financial position. Here's an easy way to remember. If it's money coming in or going out as part of your normal operations, that will be part of profit and loss statement. If it's something you own or it's a net worth of the business, that's part of balance sheet. For examples, the profit and loss items could be sales revenue, wages, rent, marketing, costs, utilities, and bank fees. The examples for balance sheet items include how much money you have in your bank account, equipment you own, stock, and how much inventory do you have on hand, the loan balance payable, the amounts customers owe you, or what we also call it as accounts receivable. If you buy a coffee machine for your cafe, it goes onto balance sheet as an asset. Then your business will be able to claim it back through depreciation on the asset. But how about the electricity to run it? That's an expense on your profit and loss. And that's it. This is your crash course in reading a profit and loss statements without needing a finance degree. If you found this video helpful, hit that button so more business owners can find it, subscribe for more plain English tax tips, and drop a comment below if there are any other financial report or any business tips you'd like me to break down. See you next time!